now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. And in terms of thinking, acting, and prospering, we are here with the unemployed value Degen. Steve, what's going on, man? The subscriber base is growing. It's growing. 2,000 went from 2,000. Now you at
Yeah,
3,000, over 3,000.
I'm getting real close to doing my 4,000 subscriber special because it's taken, well, the free subscribers are taking off. The paid subscriber growth is a little slower, but it's coming along.
Mm-hmm. Yeah, y'all, $5 a month. $5. Just, I mean, you're spending that on a Kit Kat. I mean, I think one Kit Kat may cost you $5. I mean, that's like one egg, y'all. So be sure to go
Uh,
subscribe to the to the Unemployed Value
oh,
DJ. Link in the description.
$5 was lunch and you would get change back. Now it's like, what is it, 13, 18 bucks at Chipotle? It's crazy.
Mm-hmm. Yeah, agreed. So, a couple things. We got a couple companies that I would like to dive in uh, with you on, and there's been some concerns. I know we've talked about your view on whether we're going to have a boom or a bust when Trump came into office. There's a lot of volatility right now, especially with the tariffs, the world peace stage. Everything goes at an all-time high, over 3,000. And then I've been kind of just doing some research on two companies that you've mentioned multiple times in your newsletters, but then also on podcasts, but Jackson Financial and Medical Properties. And so I was doing some research on like, okay, if we were to go into a recession, because this was the question that was asked Trump, are we going to have a recession? He wouldn't comment on, to my understanding. And um, and so Medical Properties is a real estate investment trust, and certain real estate investment trusts perform pretty decent in recessions from what I was reading on Investopedia. Things like medical properties, medical REITs, as well as rental properties. When you get into some of the other, commercial or whatnot, those can perform poorly. And then you have Jackson Financial, which sells annuities. And I was kind of researching, okay, does annuities um, perform well in recessions? And usually fixed annuities do. Variable annuities can be risky during a recession. And so are these two like recession proof companies, just speaking on it from that level, if we were to head into that type of environment? And then we can get into like the companies specifically and why you think they are valuable.
Yeah, well, you typically would think of, so in a typical recession, one of the problems is what we've been going through isn't even close to typical. I mean, we're still feeling all the reverberations after COVID, and then you had the Biden administration where something like 80, 90% of the job growth was all government and healthcare administration. So you had 4 years where the consumer was struggling, industrials, so any of these manufacturing indices, a lot of those have been saying that we've been in a recession for about 3 years. But I think Trump is in the calculation for a recession, they add up private consumption and investments, and they add up government spending. So if you cut government spending, it's going to show us as if we're a poorer country, right? GDP could fall because government spending falls, even though, like, not to pick on government, although I mean they deserve it, but just imagine if we went from our current tax code, which is millions of pages, to we had a flat tax and everybody just paid 10% or whatever it was. Well, half of the accountants would be fired, right? But does that mean we're less productive as a society? Like half of the accountants would have to go get a job making something else, and real productivity would increase, but it might look by the numbers, oh, fewer people are getting paid, GDP shrunk. So the mathematics of this number of GDP and what real productivity is if you're spending all this human energy just to overcome all these obstacles that other people put in your way artificially, that doesn't mean we're a richer society. So there's a chance you fire, 1 million federal government employees, the number will be small, but we might be a wealthier, more prosperous society. And I want to say, uh, I forget which country did this recently, but I think it was, well, Argentina is a good example of it, but that's still early on in their progress. But no, I think it was um, Italy was doing something similar. They started a little bit earlier than ours, and the numbers are coming out good over time. So it's I think Trump is reasonable to be worried that the government data bureaus are going to say that we're in recession because the number gets smaller. But if the number gets smaller again, because just like if we didn't need as many accountants because the tax code was simpler, that doesn't make us worse off as a society. So, and then you have, well, the news media, and who does, if the news media is going to bang a drum and say, oh, this is so awful. I mean, the news media has been saying bad things about Trump for the last 8 years. So when you have some sort of spin doctor doing things to the numbers, I think Trump's right to be cautious. I don't think we're heading into a recession in the sense that, oh, industrial production is going to slow down and a bunch of people in the private sector are going to lose their jobs. I think we're probably heading into something more the opposite of that. I think the odds are pretty good that the news will tell you that we're in a recession, just like the news told you that we were in expansion when the only jobs created were government employees. So I think but as far as how Medical Properties Trust and Jackson Financial are going to do, Jackson Financial, their income, the way they pay their dividends, the way they earn their money, that's mostly on assets under management. They've got about $330 billion of assets under management from variable annuities that they've sold in the past. Now, if there's a big recession, maybe it's the case that they wouldn't have an easy time selling new variable annuities for 6 months. But for all the variable annuities they've sold in the past that they're collecting this management fee on, that doesn't change. So Jackson Financial is going to be totally fine through all that. People almost never surrender an annuity because it's a contract between you and the insurance company. And if you surrender it, you just have to accept what they give you, which is never really a great amount. So, and the people that got the annuity in the first place, they're very risk averse. So they're happy to have that insurance company give them a guarantee. They sleep better at night and they don't want to undo that. So annuities are very, very rarely ever surrendered. And just Jackson Financial as well, they were a spinoff from Prudential, and it was a very young division. So their annuity cohort, they tend to be very, very young people. These are people in their 60s, not people in their 80s. So there isn't even really all that much risk of their customer base passing away and then losing all of their assets under management through inheritance. And then Medical Properties Trust, they're
Really quick on Jackson. So with variable annuities, are they so they're a fixed rate that's or no, they're a rate that's paid out. Fixed, you got fixed annuities and variable. And so like if there was like a recession and interest rates were cut, would that affect the variable to where you're receiving less yield on that annuity, or is that how it works?
Yeah, so for the individual as a client, as a customer of Jackson Financial, once upon a time, the only kind of annuities were fixed annuities, and they were done in life insurance companies. People would say, so you're coming out of the 1960s, 1970s when people had these employer pensions. And as that started to go away, as companies went bankrupt and they were left with Social Security or nothing, people wanted to replace that employer pension. So how can I go to a life insurance company and say, hey, life insurance company, would you pay me $1,000 a month for the rest of my life? And they would say, sure, that'll cost you, $575,000. I'm like, they're going to take that an interest rate and they're going to take their life insurance skill to estimate how long you're going to live. They're going to make a guess as to, what it's going to cost to pay you $1,000 a month for the rest of your life. That's a fixed annuity. Those almost went extinct with the zero interest rate environment because the cost of that, you go to the insurance company, what does it cost to pay me $1,000 a month for the rest of my life? They say, oh, well, that's not $500,000. That's $3 million because interest rates are zero. So fixed annuities almost went extinct. To survive, the annuity companies came up with variable annuities. So now you're going to take some stock market exposure. They're going to use derivative hedges that says, okay, if the stock market falls, your account doesn't fall. But if the stock market goes up 10%, your account maybe only have a, less than stock market performance when times are good. But when times are bad, there's going to be all these derivative contracts that protect you to the downside. And this is really attractive to clients. There's even a whole new cohort of ETFs that kind of mimic this. Some people really like it, but it's for more risk-averse people. So if there is a stock market crash, the whole point of the variable annuity is your investments are protected. And if the stock market's roaring, you're not going to do as well as the stock market overall. I mean, it's people that had their money in Jackson Financial when the Nasdaq's up 30% in a year, their account's not growing 30%. But that was a deal they made in exchange for the safety and the security. Variable annuities aren't right for everybody. This is a very small group of really risk-averse senior citizens that need those kind of insurance company guarantees. But for the people that need them, it's good that they're out there. Now, Jackson Financial was a spinoff from Prudential. Once it went from fixed annuities, where the insurance company was promising you money for however long you live, you go to variable annuities, you don't need to guess how long somebody's going to live. It's just you have this assets under, it's fine. So they don't even have to estimate how long they're going to live anymore. They don't need to be a part of the life insurance company. So Prudential spun off Jackson Financial to be its own entity. Say, look, this isn't really life insurance anymore. It's not a good fit. And they sent it out on its own. But as far as the business itself, I think they're going to do fine in a recession.
Yeah, thanks for sharing that, breaking that down for us, especially, just being able to, know and be aware of like, okay, what type of company this is, the product they sell, and how does this product benefit the customer in the event of a downturn. And so, what was it about? So I watched your whole video on um, Jackson Financial, where you went through the financials, you did the your projections for the company and everything, and explained everything. And so I have to go actually watch that again. But when you did that breakdown, it was really intriguing for me to invest in the company because it's been sold off of the highs. It saw a little bit of weakness since I got in, but I've still been buying in because I mean this looks like a you know um, a long-term hold for where this could be like a multi-bagger. And so what is it about the financials? Because I mean, you even mentioned on the video like you're planning on holding this in your wife's Roth IRA for long term. And so what is it about the financials that's really speaking to you?
Yeah, so as a value investor, I find something cheap. And when I first screened for Jackson Financial, I think it was like a price to earnings of 2 or 3. I mean, it was just right now it's a price to earnings of maybe 4.5, or it might even be down to 4 with this recent sell-off. This thing is extremely cheap for what it is. So you got to ask, well, why is it cheap? Because then if you only go for cheap stuff, you might find a value trap. And I found 2 reasons why it was cheap. And the first reason is already gone. So when Jackson Financial was a spin-off from Prudential, Prudential spun off half and then kept half. So for the first 2 years of Jackson Financial as a public company, Prudential was just selling into the market constantly. So the stock price, no matter how well they did, no matter how much the company grew, couldn't catch a bid. So the company was trading at a price to earnings ratio of 2 or 3, and the stock price would not go up because Prudential was selling. But now that Prudential sold off all their stake, you had this, rubber band explosion from $40 a share to about $120 a share. And then with this value sell-off since started in last November, it's crashed down to 75 or 80. The other reason why the stock price is under pressure is the derivatives. So after the global financial crisis in 2008, when all these investment banks blew themselves up with derivatives on how the treatment for derivatives. And Jackson Financial uses hedging instruments, they use derivatives to make sure that when there's a stock market crash, their clients' accounts are made whole. And they use conservative derivatives. They do a good job with that. It is hedging, right? Hedging costs money. It's an insurance. They do a good job with it. But as the market has volatility, as interest rates have volatility, they're going to have mark-to-market losses on their derivative hedge portfolio, which is way bigger than their net income for any quarter. So if you look at their quarterly net income, you're going to see one quarter where they make $65 a share in earnings, and the next quarter where they lose $30 a share. It's terrifying to see a company that's, a $75 stock and like, what's this quarter where they lost $35 a share? That's crazy. But that's the mark-to-market valuation on these derivative hedges, which, over time they average out. And over time, they cost as much as they charge the clients in the management fees to pay for all those derivative hedges. But just quarter to quarter, it's really violent. And when you have, half of the marketplace, I think 60% of active trading is done by algorithms, and the algorithms base it off of the accounting numbers that are in their system. So already all the, algorithmic traders are going to have a very hard time with this. So I think that's why you can find this company, which is, as far as quality goes, they're the market leader. They're the number one seller of variable annuities. I think the second place is Equitable Financial. Equitable Financial trades at a price to earnings ratio of 15, which is where Jackson Financial is going to end up once the market understands them. So you're the number one leader in variable annuities. That whole segment should be a growth industry for a while because we have the baby boomers retiring. We have this silver tsunami with all these senior citizens retiring. And variable annuities are for the really low risk people. And the really, really low risk investors, oftentimes that's when a baby boomer becomes a widow, right? When you have a husband and wife, especially in that generation, a lot of times the man is handling the finances and men tend to handle risk or enjoy risk in their investments a little better. But the wife has to plan on being a widow for about 10 years because women live longer than men. And when they get married, when people get married in that generation, the men tended to be a little older. The husband tended to be a little older than the wife. So the average baby boomer has to plan on being a widow for 10 years. That's really when you're going to have this huge rush of clients coming in the Jackson Financial to buy a variable annuity because they need that risk protection. So you're going to have, I think, increased volumes maybe for the next 5-10 years. And then you have this with the growth of the stock market, the assets of the American middle class. The American middle class has $150 trillion of assets. Just senior citizens, I think, have $75 trillion in assets. That's very different from what's happened in the rest of the world. You look at Canada, you look at Australia, ever since the global financial crisis in 2008, and Europe also, and the UK, right? The wealth of the middle class all over the rest of the Western world has been flat since 2008. In the United States, it's been many multiples. So this is a very wealthy demographic. I mean, that kind of wealth in the middle class never existed before. So there's a lot of, and again, out of that 150 trillion in assets, Jackson Financial is managing 330 billion. So there's a lot of room to grow. And then there's another aspect of these insurance company-like businesses, which is as they're selling new policies, they have to keep on setting cash aside for their loss reserves. Well, last year, Jackson Financial had $1.4 billion in profits. And this is a company, what are they trading at right now? $6 billion? Something like that. So anyway, $1.4 billion in profits. They returned to shareholders about $650 million. So they've got about a 45% payout ratio. Now, the people that run this company, they're not really interested in acquisitions. They're not really interested in growth. They're going to focus on return of capital to shareholders. And once you get past that silver tsunami, once you get past all these people retiring, when their new policy growth is slowed down, I think you're going to see the payout policy go past 100%. I think maybe 5, 6, 7, 8, 9, 10 years from now, you're going to see a year where Jackson Financial has $2 billion in profits and their return of capital to shareholders is 2.5 or 3 billion, because they're going to be unwinding some of these loss reserves they built up when they got all this new business from the baby boomers. Because from baby boomers to Gen X, there's going to be a drop off in size and volume. So this is a company where just on the multiple expansion, just on the price to earnings ratio, just to be valued in line with Equitable Financial, who's the number 2 person in variable annuities, it's a triple from a PE of 4.5 to a PE of 15. Then in the meantime, they're taking their income, They're doing aggressive share buybacks. They've already shrunk the float from, I think, 94 million shares to 75 million shares. They've only been public since 2021. They're doing aggressive share buybacks. Whenever they get money, they're returning it to shareholders. So I think if you're going to have a triple and multiple expansion and they're doing these aggressive share buybacks, and these share buybacks right now, it's still trading at a discount to book value. So the share buybacks are highly accretive. You see something like, Apple or Microsoft does share buybacks. Okay, but you're trading a price to earnings ratio of 30 or 40. This is a share buybacks at 60 cents to tangible book or a price to earnings of 4.5. So these share buybacks are really impactful right now. I think you're looking at a world where if you just want to hold it for 4 or 5 years, I think in 4 or 5 years, it's going to be a 4 or 5 bagger as you get a triple from a multiple re-rating and you get 4 or 5 more years of share buybacks. And then if you want to hold it for the longer term, once the silver tsunami is over and the baby boomers, are passing away and the annuities start being sent out to people's estates and they start unwinding all the capital reserves, you're going to see a year where the payout policy is over 100%, where they're just distributing huge amounts of cash to shareholders. So this is a company that it's not often that you get a quality name that's also a value name, that you have, a market leader in their space also trading at a huge discount. And I think it's just because they're new on the scene. It was an IPO in 2021. Then you had rising interest rates. The share price was depressed. I think the story hasn't gotten out and people haven't found it. But I think, it'll take a few years for the multiple expansion for the re-rating, but it's on its way. It's already started.
Yeah, for sure. I mean, I mean, when I saw the video that you did on this company, I was thinking like, okay, me having at least a 5-year outlook on my investments, and that just kind of it was light bulb that came on for me. I was um, listening to something about Warren Buffett, and just he was talking about, hey, you need to have like a 5-year outlook. Rick Rules told me that multiple times too, and so that's something that I've been really focused on in my portfolio. And so when I saw the video that you did on Jackson Financial, it was a light bulb that went off for me. Like, okay, this is something that could be a very long term hold that's going to provide value in increase in share price. And so, yeah, solid company.
Yeah. Yeah. It was, I don't find a lot of quality names because when you're digging for value, you don't find a lot of quality names. And there aren't a lot of value investors. A lot of people that say that they're value investors are really quality investors. There's that rare time when, the even a blind squirrel finds a nut once in a while. This is probably one of the best things I found from turning over rocks looking for value stocks.
Yeah, for sure. Okay, so transitioning to medical properties trust. I was looking at the chart for medical properties. It's back in this kind of resistance zone of $6. It fell all the way down to $3 and some change. They pay a decent dividend, and in medical properties or just medical REITs in recession seem to perform well. And so I just want to get your take on that particular company, how you would expect it to perform in a recession, and just your outlook look on it in general.
Yeah. So medical properties trust, it's probably one of my, um, well, there's a couple stocks that I found that I liked and I invested in. And then after I found them, they became subject to short attacks. And at the time, I thought, well, short sellers, they're just doing research. They're trying to find the right price, and there's a disagreement. What's the disagreement? And the more I saw some of the short sellers' behaviors, the more I realized that that's not what a certain chunk of short sellers are doing. There's a certain chunk of short sellers. What they do is they try and find businesses that are opaque, businesses that are hard to understand, and then they engage in defamation campaigns. So that's what I believe happened to Medical Properties Trust. And the company even sued. And there was some information that came out when the lawsuit. So one of the people defaming them, with the discovery of the lawsuit, they were getting paid $50,000 a month from a hedge fund profiting off of this short just to, write scuzzy things about them on Twitter and on the internet. So is really a case where I think the negative sentiment on the stock is mostly a defamation campaign. Now, REITs generally and all real estate, they've all come under stress from rising interest rates. right? So when we went from zero interest rate policy to where we are now, where benchmark rates are 4%, 4 or 5%, coming into that world, you know, real estate investment trusts were thinking, okay, what's our right, you know, what's the right loan to value ratio? How much leverage should we use? And the right amount of leverage in a zero interest rate world is very different from the right amount of leverage in the world we're in now of higher for longer. So a lot of real estate investment trusts had to delever, right? So they had to sell assets. And now you're selling assets into a time when potentially real estate prices are crashing. So you're going to be selling assets and maybe even not getting what you paid for them. So Medical Properties Trust had to delever. They had to do some asset sales. And in every case except for one, they got at least what they paid for out of it. So they had a very glorious deleveraging. I think I forget how many billions of dollars it was, but they sold a pretty good chunk of assets. And in every case, it was at book value or better, except for one. Now, the question is, well, was this, you know, did you sell off the crown jewels or was this representative? Management claims that it was kind of representative. But then how well do you trust management? Personally, I do trust management. I think they're fantastic. But, you know, taking devil's advocate into account, that's the argument is, well, maybe they sold the good stuff and they're left with the bad stuff. So all REITs were under pressure from rising interest rates. But hospitals, hospital operators were really under pressure, first from COVID, and then from inflation and from rising interest rates. So hospital operators got burned on 3 levels. So even though there was a lot of COVID funding, people stopped going to the hospitals for elective procedures. And that's where hospitals make a huge chunk of their revenue is on elective procedures. Because in the MRSA outbreak, or was it MRSA, what is the, before SARS, right? So SARS and MRSA, people get sick, people catch a lot of these diseases in the hospitals, and old people know this, right? Senior citizens with needs for elective surgeries know this, like don't go to the hospital, you're going to get sick. So the elective procedures dried up. At the same time, on labor costs, they got crushed by these shift nurses. So the wages for shift nurses skyrocketed. And then when inflation hit, so hospitals renegotiate payments from Medicare, Medicaid, and their insurance companies once a year. So when we had inflation hit 9%, the hospital's costs were really going up, but then they had to wait a whole year before they could negotiate higher pay from all of their sources. So hospital operators got wrecked. Now, Medical Properties Trust, they're a hospital REIT, right? They're the landlord. They own the hospital and they acquire most of their hospitals because they do a sale leaseback contract. So they'll find a hospital operator that owns hospitals and they want to use that cash for something else. They want to become more capital light. So they'll do a sale leaseback contract. Now, the thing about Medical Properties Trust is they had acquired tenants that were some of the riskiest tenants, right? They had acquired tenants that in the period of zero interest rates, you know, expanded like nobody's business. And then like Warren Buffett says, well, when the tide goes out, you see who is swimming naked. Medical Properties Trust's tenants, some of them were swimming naked and some big ones were swimming naked. Now, in commercial real estate, losing a tenant is a huge problem because you might have a 5-year lease or something like that. These are triple net leases. The tenant is covering maintenance and insurance and taxes. The landlord is not covering those things. The rent payments are pretty small. You know, it's maybe cap rates of 5, 6, 7%. These are very small rent payments. If you lose a tenant, you have to go to Colliers and have them help you find a tenant. They're going to take 6 months to find a new tenant. They're going to charge a commission that's about 4 or 5 months rent. And it's typically customary. You give the new tenant 4 or 5 months free rent. Meanwhile, you're paying all those triple nets that the tenant was paying before. Now you're paying those. You lose about 2 years worth of value whenever you lose a tenant. And so I think people saw this Medical Properties Trust had these huge tenant bankruptcies and said, oh man, this is devastating for a landlord. This is devastating for a REIT. But when it's an acute care hospital, this was my argument from the beginning. When it's an acute care hospital, something different happens. You don't go to Colliers and find a new tenant. You go to a bankruptcy judge, and the bankruptcy judge says, well, should this town's hospital shut down and then everybody's, you know, father, husband die of a heart attack because there's no hospital? Or does the bankruptcy judge prioritize the hospital staying open? And does the bankruptcy judge hold a fire sale auction and make sure that there's a new hospital operator? So as a REIT, as a medical property trust REIT, of acute care hospitals. The bankruptcy judge is replacing Colliers. The bankruptcy judge is finding your tenant. And it's the hospital operator that takes the hit to the value for that, not the landlord. The landlord gets to have a new tenant that gets put in by the bankruptcy judge, and they don't have to suffer all the pain. You don't have to give the new guys 6 months free rent. You don't have to give Colliers this 4 or 5 month commission. You don't have to wait 6 months of not getting paid. So my argument always was Medical Properties Trust has the worst tenants, and it doesn't matter. And I think in the end, I got proven right about that. But I still can't believe that as the stock price got pushed down, at one point, this company was trading at 25 cents the tangible book. I mean, 25 cents the tangible book on a portfolio of 400 acute care hospitals. Like, that's insane. That's nuts. But it is true. Their largest tenant was bankrupt. Like, this was a real problem. Now, you also had the deleveraging. You also have, debt maturities. They just recently refinanced some of their debt. And you also have these short attacks. And these short attacks, this defamation campaign, it does work, right? It does cause trouble. Even though I look at their assets and I think there's a lot of value there, their credit rating has suffered enormously under this time period. So they just refinanced about $2.5 billion of debt, and they got an average rate on that of about 7.8%. And I think that was, it's not going to destroy their business, but it's pretty rough because, again, you have a situation where your largest tenants are going through bankruptcy and your official credit rating is getting downgraded. But this process is behind them now. So their largest tenant, that bankruptcy process is over. There are new tenants in there. And they were, now, hospitals' collections take a lot of time. So hospital collections, Medicare and Medicaid insurance companies, they pay you eventually. So the new hospital operators coming in, they need some time before their collections have caught up with their expenses. So it's like 15% of their portfolio that was caught up in one giant bankruptcy. It's a huge amount of money. The new tenants that have come in are on half rent for the year 2025, and they're on full rent for the year 2026. At the same time, when their largest tenant went bankrupt, they had a debt covenant that no more than 10% of their tenants could be bankrupt. Well, their largest tenant was 15% of their property. So that one bankruptcy violated their debt covenant. So when they renegotiated with their lender said, okay, well, you have to limit your dividend. You can't pay a dividend of more than 8 cents per quarter. Last quarter, their funds from operations were 18 cents, but they only paid a dividend of 8 cents. So what that debt covenant is gone now. I don't know, because I don't have an inside scoop into management's thought process. But if they wanted to, right, next quarter, that dividend could go from 8 cents to 16 cents. And I think it's also very possible. So they lost about, the added interest expense from refinancing their debt is going to, take away about 4 cents per quarter that they could have paid in a dividend. But now that it's 2025, and these hospitals are on half rent, that's going to add about, I think it's 5 or 6 cents a quarter. So you have a world where this company's dividend could go quarterly from 8 cents to 16 cents or to 18 cents. So their dividend could double next quarter. And I think it will double at some point within 2025. I just don't know when management chooses to do it. Originally, that covenant expired in September, but with the refinancing of their debt, that covenant's gone now. So they no longer have anything restricting the dividend. And now it's just a question of what's management going to choose to pay out in dividends. So if you're looking at, if they really do have an 18-cent dividend, you're talking about having the stock paying 72 cents. And if you're paying 72 cents, what's the stock price now? $6? You're talking about that's over a 12% dividend yield, which is pretty high, pretty aggressive. And then over time, as the company gets to their tenants paying full rent in 2026, and there's also, now that once the bankruptcy process is entirely finished, they have the possibility, and management talked about this in the last earnings call, of refinancing some of that debt that they got at 8%, 7.5%, because even a 15-year mortgage right now is 6.5%. They really took a bad hit on that interest rate while their credit rating was down to the tenant bankruptcy. So Medical Properties Trust is on the other side of a lot of their problems. And if I put just a 10% dividend yield on where I think the dividend is going to be, I think Medical Properties Trust will be a $10 or a $12 stock at some point between now and the end of 2026. And in the meantime, they're paying dividends all the way. Now, but what's amazing is how much short interest. I mean, the market seems so convinced that these people were going bankrupt. And what's amazing is the fundamental story, the bankruptcy process with their largest tenant is finished, right? All the near-term debt maturities, I think till 2027, have been refinanced. So this company is out of the woods, right? The danger is over. And it's just a matter of when does the stock price get back to 10 or $12? Is it on the next dividend raise or is it on a short squeeze? But there's a huge short float. I think it's about 35% of the float is short on a hospital REIT. I mean, this is still pretty crazy. And they still have a lot of value to unlock. There's a lot of moving parts going along. They had one other smaller operator that went through bankruptcy. They have a couple hospitals that were under construction, and they're looking for somebody to take over those and say, hey, like we'll finish the construction cost if you sign a 20-year lease. What's amazing about Medical Properties Trust's leases is a lot of commercial real estate is on 5-year leases. These guys do 20-year leases that adjust upwards with inflation. So when CPI hits 2 or 3%, their rents go up. So every year they have a rent increase. So if you look at where the dividend will be for like 2026 with the automatic rent increases from CPI, with some of their tenants getting back into full payment terms, I think it's going to be, 10, 12, 13, $14 by the end of 2026. So it's weird because in my mind, this is one of the lower risk investments out there to be a landlord of hospitals. But then I never thought it would sell down to $3 a share. I never thought you'd see 25 cents a tangible book. But you have this aggressive defamation campaign where people just say they're going bankrupt. People say they're all going to get arrested for fraud and go to jail. And people say ridiculous things about this company. It's just amazing. And I think most of it is just this aggressive defamation campaign.
Mm-hmm. Wow. Yeah. So, so how does this stock rank in like in your view, compared to like Jackson Financial? It's like, okay, we know this silver tsunami's coming in. I mean, hospitals are always going to be around too. And there's obviously things you have to watch out for in the meantime, like what is management doing, or has anything changed, when you're assessing a company over time or holding on to them over time. How long, in your view, do you think this is a hold for? Like, are you looking at, okay, 2026 it goes up to $12, you collect dividends along the way, and then you may consider selling at that point, or do you think this is like something that's they may refinance their debt if interest rates come down, and this may be a longer term hold?
Yeah. So if you follow REITs, a lot of REIT management teams are empire builders. They will do stock-based acquisitions of assets to grow their empire. Medical Properties Trust, up until rising interest rates and the deleveraging, they were growing book value per share at double-digit rates. They were growing book value per share by more than 10% a year. And this is a world where, as a REIT, you have to pay out 90% of income in dividends. So it is mind-boggling how well run this company is to grow book value per share at double-digit rates while you have to pay 90% of net income out to shareholders. This is, I think, an incredibly well-run business that if you were a dividend investor, and some people, like I'm a value investor, I'm going to sell this when the price to book hits about 1.2 times, and currently it's trading at about 60 cents. So because I'm a value investor and I would get out of it. But if you're just a quality compounder and you like that dividend income, this easily could be something you could hold on to for, 10, 20 years, because they're the market leader in their space. They're the largest hospital REIT. Unlike the value trap REITs, they're not issuing shares to acquire more assets. They're growing book value per share over time, and they're growing dividends over time. So if you look at the growth trajectory leading up to this, and look, a lot of companies got hurt by rising interest rates. A lot of companies said, hey, we're over levered. We have to sell assets. I mean, that happened to Hanes Brands. Like if it can happen to underwear, it can happen to anybody. Right? So Hanes Brands had to sell Champion for $1 billion because they took out all this debt when interest rates were low. and then the economy hits a rough patch and they can't service the debt at higher rates. But medical properties trusts deleveraging is over now. That's behind them. I don't know when they're going to return to growth again. That might take a couple years. They're still kind of digesting everything that happened. But I think once all the bankruptcies are behind them and once all their tenants are on full rent, yeah, they can return to growth mode. They can find hospital operators to do sale leasebacks to and get more hospital assets. So yeah, if you're a dividend growth investor, you could easily hold this company for 20 years. As a value investor, I'm going to flip it and recycle that capital when it hits the price to book of about 1.2 times, which is, where they've traded at in the past, give or take. And if we really are entering a period, so Trump and Scott Bessent seem really intent on lowering interest rates. As interest rates lower, typically that's a period where anything with a fixed income, like a utility company or a real estate investment trust, do really well. Because now people are going to compare, if you compare medical properties trust dividend with a 4.5% 10-year treasury, it doesn't look as good. But if you compare it with a 3.5% 10-year treasury, it looks a lot better. So I think there's a lot of tailwinds for medical properties trust in the near term. And myself, I'm going to sell. I got a price target in my head of, something around $10, $12. It's currently my largest position. So medical properties trust is really a disproportionate share of my portfolio. It probably is too heavy of a weighting, but I am going to sell. But if you're an income investor, if you're a dividend growth investor, you could hold this thing for a long term.
Yeah. Or, I mean, there's multiple things you could do. Load up, sell half of the amount of shares or whatever the case, however you all do it out there. But I'm just appreciative of Steve. This is a massive amount of research. I mean, just going into um, the the details, the minute details of this. It's like it's impressive, impressive. That's all I got to say.
Well, I was kind of, in hindsight, it didn't feel good at the time, but I'm kind of glad I got fired from my teaching job because it gives me enough time to do the due diligence and to dig into these companies. But man, when the short sellers are saying all sorts of crazy stuff about your company, it really questions your sanity, right? You have to keep on, you have to do so much more work and so much more research because you've got a group of people, spreading a bunch of lies about a company. You have to go in and double check things. And so I think I'd ended up doing a lot more research about this company because there was so many lies being spread about it. But yeah, no, I think the management team is fantastic. It's kind of an interesting story about the chairman is the founder of the company, and he took his little business in Alabama and grew it into the largest hospital real estate investment trust in the world. And they sold their Australia assets, but they have hospitals in Switzerland and hospitals in the UK. It's a global presence, and they're the market leader in their space, and they're I think they're doing a fantastic job. So yeah, I think it'll be exciting to see when they return to growth mode. But there's still some obstacles, right? You need their tenants through bankruptcy to get to full rent. There's a bunch of things in the potential upside. So when the bankruptcy of their largest tenant took place, they kind of did the Solomon cutting the baby in half. There was 18 hospitals in the group, and the bankruptcy judge gave 3 hospitals to the operator, but gave the operations of 15 hospitals to Medical Properties Trust. Well, the operating companies for these hospitals, the land and the building are usually about the same value or less value than all of the equipment in the hospital, all the CAT scans and the PET scans and the CT scans, all that medical equipment is usually at least as valuable as the hospital land and the building. So Medical Properties Trust lost 3 hospitals in this bankruptcy proceeding when they split assets between Medical Properties Trust and the tenant. But then Medical Properties Trust got 15 hospitals full of equipment, which they didn't own previously. And we still don't know how they're going to arrange this deal. So they have new tenants now to come in and take over these hospitals, but we don't know yet how Medical Properties Trust is going to get paid for all this equipment. And it's probably somewhere between, it's between 500 million and $2 billion. We just don't know how much it's going to be. But at some point, these new 15 operators, how are they going to, right now they're using all these facilities. They're called, temporary operating companies. But we don't know how they're going to do like a seller financing, how they're going to finance this whole package over time and how they're going to monetize this. So it's been a rough journey these last couple of years with their largest tenant going bankrupt. But at the end of it, I think they're going to come out. There's a lot of things that can go right for them now. And all the threats, now that we're this far past COVID and the inflation spike, hospitals operators starting to get their legs under them again. They're not under pressure anymore. So I think there's a lot of good things that can happen to medical properties trust from here on out.
Yeah, that's amazing. That's amazing. Well, appreciate you, Steve, for giving us that detailed analysis. You all, he goes even deeper into the financials and everything on his channel as well as on his Substack. So be sure to go subscribe to the Substack. It's only $5 a month. If you're watching this channel, you can't afford $5 a month, then we got some serious work we need to do with your finances. And so yeah, Steve, appreciate you for coming on. I'm gonna be sure to link to your YouTube as well as your X account and your Substack in the description below. You all be sure to go tap in with Steve. And any last words for the audience?
Yeah, well, I made a model portfolio. It's my pinned Substack post. And in it, I have the like kind of the core philosophy is inflation protection, and it's gold, oil, and land. And so Medical Properties Trust was one of the way I could buy cheap land for 40 cents on the dollar for my, inflation protection strategy. But gold just hit $3,000 an ounce, and the gold miners are still not catching up. Like the gold miners, they're starting to rise a little bit, but nowhere near pricing in $3,000 an ounce gold. And I think the reason for that, because you always have to figure out, is this a value trap? What's the reason for it? In the last gold rally, mining costs rose along with the gold price. The miners never made any money. But this time it's not happening the same way. This time the gold price is rising because central banks are buying and the mining costs are not rising with it. So you're starting to see some of the mining companies just gushing enormous amounts of cash. So I think that's probably pretty timely. And then on the oil side of things, there was a new news article out. Citadel, like Ken Griffin Citadel, just bought a natural gas producer in the Haynesville. They spent $1.2 billion. This is Citadel. Like, what the heck are they doing buying a natural gas producer in the Haynesville? So I think the data center build out, right? The artificial intelligence revolution, people realized, oh, we need the utility companies because they're going to provide power. But at some point, people have to realize like power doesn't come from the wall. Power comes from something that you're burning. So I think we might be getting pretty close to people realizing that for the data center build out, you have to go all the way down to the energy producers. So it's been a rough 2 years in energy. All my oil stocks, all my natural gas stocks, they've just been having multiple compression for the last 2 years. It's been so painful, but it's kind of
Especially
optimistic
recently.
to see. Yeah. Yeah. Recently,
Recently with
but I mean,
Valeris, and that was painful. I had to go in and deploy a little more capital, but yeah, that was painful.
yeah. But to see Ken Griffin Citadel buying a natural gas producer in the Haynesville is that could be like the catalyst. Like the smart money realizes we need hydrocarbons. So it might be turning here. I think that's pretty interesting. So, but the gold price is $3,000 an ounce, and the miners still are not catching a bid. So I think it's just going to be when the cash flow shows up, people will finally realize that it's real. I think up until recently, a lot of gold price projections for 2025 were still $2,500 an ounce. People thought that this price was going to give back some, and it didn't. It just keeps on grinding higher. So we'll have to see. But yeah, my pinned write up on my Substack, I talk about inflation and the gold, oil, and land because that's what worked in the 1970s as the best performing assets for a period of higher inflation, which I know inflation's on the retreat right now, but I think so. Both Trump and Scott Bessent are trying to lower interest rates to bring the economy, warm up the economy. If we can get the Treasury down to 3.5% on a 10-year Treasury, you get about a 5.5% 30-year mortgage. At 5.5% on a 30-year mortgage, I think you could finally see the housing market unthaw. And if the housing market unthaws, you'll see people aren't going to refinance cheap mortgages, but you'll see a lot of people do home equity loans. Right? People have been people have enormous home equity that's been trapped and they can't access it. And there's going to be a lot of people out there that would say, look, we're in our 30s, we're in our 40s. We don't need to have $400,000 of home equity. We can live it up a little. We can take out a $100,000 home equity loan. We can buy a Harley Davidson. We can buy a Winnebago. We can go on a nice trip. So I think a 5.5% 30-year mortgage unlocks all of that. And I think that, Trump and Scott Bessent seem hell bent on getting a 3.5% 10-year treasury. So I think they might get what they want. I think that might be what we see here.
Hmm. Got it. Got it. Yeah, definitely have you back on for some updates as things continue to unfold and unravel, and everything in this new environment. So appreciate you for coming on, Steve. You all be sure to click the links in the description below, and we'll touch base again.
Thank you, Daryl. I appreciate it.